On this episode of Pennies Going In Raw, Hugh and I discuss this week in the market, traders for a cause technical videos, and more.
Hey yo, check 1, 2. This is Flavor Flav in the building for the Atlas crew.
Atlas Trading, what the fuck is up?
There are traders, there are prodigies, and then there's legends.
We're on 4%, baby.
No way.
4 fucking percent. Buy the fucking dip.
Hey, who told me about IDEX?
Like, dude, what the fuck? Like, someone just made, like, a lot more money than me on my trade.
You find out life's this game of pennies.
Did you check the portfolio?
Pennies. The margin for error is so small.
I bet Warren Buffett never did that.
And they out there making money right now off of penny stocks.
Them two guys is putting in work to make y'all rich.
The pennies we need are everywhere around us.
Time to think big.
Pennies Going In Raw.
Featuring Dan, Deity at Dips.
And Hugh Honey. Produced by Vinny Strokes, baby.
Welcome to Pennies Going In Raw. Today is Sunday, October the 18th, and the large cap red days are happening quite a bit. Just last Thursday, we saw one of those red across the board days. How are you on that one?
Yeah, that one stung a little bit, I'll be honest. I think everything that I owned was down 5%.
Yeah, it was actually, it was kind of like that for me during the middle of the day, but it started to recover really nicely towards the end. And that's kind of one thing I've noticed this time as opposed to some of the weeks in August or early September, is that penny stocks aren't quite getting pummeled and beat down as much as they were back when the market was red. You think that's because they're already still so beat down from August red days and that they're just at like stronger supports?
Yeah, exactly. Stronger supports. You're not seeing halt downs in the market, which helps.
That's always nice.
Yeah, that's always nice. And then also, you don't have the dry volatility of like the summer that usually comes and stuff like that. So that's really good to see as well.
Yeah, and but one thing we have seen that's been going pretty well was Fubo. I remember Zach called that around 9:20, and it had some good news, and that one's been running quite a bit. Do you want to kind of touch on why that one was running? Because I think we haven't recorded one since it was called, and it's had a good 20, 25, 30% run.
Yeah, well, I mean, not only, there's speculation that they're getting into, like a gambling. They also just had a huge purchase. It was $4 million. Huge purchase. I think that was Thursday night or Friday. So that was awesome to see because you love when, it's really nice when you see insiders putting money where their mouth is. So if you see someone, any kind of money, but when you see someone putting up a substantial amount like that, that's great to see. And then also it shortens the float a little bit. So by doing that, it shortens the float a little bit. And then on top of that, it's the speculation standard that, okay, this could be the next Roku, and then you have real people coming out and saying, hey, this is actually a really good service. It's not like Genius where everyone was like, oh, like it could be Disney. You have real people coming out and saying, hey, this is a really good platform that they have. They're just going to build on it and add to it.
Yeah, everyone just always, it's so much different when it's actually a real thing that people know about. Like, whenever it was UAVS, anytime there was like a 9-year-old with a drone outside, someone would take a picture and be like, UAVS, rocket emoji, but Fubo is a real thing that people actually use and know about.
Exactly. And it has literally staggering reviews, which is really, really cool to see. Like when you see something that's this undervalued or, I don't want to call it a penny stock because it's not, but when you have something that's with the market cap of this size, but then you have it on national TV and you have, real people talking about it other than traders, that's when it gets exciting because, there's a future. When you walk out of your computer and you're seeing the real products or the real company, just to put this in perspective, kind of like Tough Built. Like when I saw Tough Built in Lowe's, I was like, okay, this has some serious potential. Same thing. When you walk in or, when you see Fubo, it's a real product, but it has such a small market cap, you see the potential there. So, I love it. Of course, the insider buying, I love that. The only thing is their debt. They do have quite substantial debt, but when they get their market cap up, that debt won't look so endearing. And on top of that, they're an expanding company. They're a growing company. Debt is expected. I don't think that you're never going to see a company that's a slam dunk, and that's their, quote unquote Achilles heel is going to be that debt, keeping that debt to somewhere where you can still manage it, but we're using it to your advantage, which they're doing a great job using it to their advantage now. They just can't over leverage themselves, because that's usually how expanding companies fry themselves. So far, I like what the management is doing. I think they've taken all the crucial steps that they need to ensure that they're not over leveraging themselves, and that cash flow doesn't become an issue. So that's kind of how I feel.
Okay, well, along with Fubo, another one a lot of people are in. It is still SPAQtober, and they came out with some news on the 15th. Fisker announced a strategic cooperation with Magna. It hit 15 in the pre-market from 14.20. Everyone was excited. The day is here. Here it comes. And then it ended up around 14 and right on the day. And on behalf of all of FinTwit, what the fuck?
And we talked about this. I love everybody that listens. I love my followers. I love our followers. You guys are the best. But there is no bigger panic in the world than when a press release comes out that the people don't understand. Twitter traders have like hands of like velvet gloves. I don't even know how to put it. Like they're like you guys need to relax. Read the PRs, read the press releases, understand what's happening.
Yeah, know a lot of people, and even newer traders have been in it. The market was down, they all got in it.
Yeah.
And if something doesn't happen fast, they're like, well, damn, I've had my capital tied up in this for so long. I'm gonna just get out and play my own thing. And they may be the ones regretting it in 2 months or whatever it may be. But it's just one of those things. If there's too much of your capital in it, take this as a learning experience of you probably loaded up too much.
Oh, exactly. And this is exactly, like, I get more headaches. Again, I love you guys, but I get bigger headaches from the DMs that I get than the actual trading that I do. You guys pray for dips, and then the dip comes and you panic sell, or where you were saying that you were going to buy. And then on top of that, you guys go balls deep on the first entry, even if Zach said they was 3.5 months out. People are going balls deep, chasing it up 30%, their entire accounts in it. You have time decay or, opportunity cost. So, of course, if Zach says it's 3.5 months out, it's going to be 3.5 months out. So, people chase it up, go full account in. You guys don't think about the risk. Your risk being that, okay, what if the market tanks? We're in election year. The market will definitely be uneasy leading into the market. We have a pandemic. The chart is now overextended because it's up 30% in a day. You guys don't leave any downside ads.
No, but I think one of the things is it really is just people like we saw it go all the way down to 11. And no one had that much then. And then it hit 18. Now everyone's just expecting it then. I don't know if they were adding on the dips too soon or what it might have been. But it is one of those things where I think it's just the price of it and the market at the time. And a lot of people had too much of their capital tied into it. And, and it's not even down like huge amounts from like what it was. So it is one of those things where take it with a grain of salt. Maybe scale back if you need to. But this is why people are getting upset with you for having just 5% of your account in it. Well, this is why you aren't worried about it.
Yeah, exactly. And as it gets closer, we have we have in 8 days, we have the vote. See, you guys need to look back at other transactions. The great thing about a bubble and the great thing about SPACs is that they all follow the same formula. We just had FMCI do their thing. Now they're TTHC, I think. You can kind of see, it's called seasonality. Kind of look back at what other SPACs did as they ran up, what they did when they were doing it. It's following the same direction as what was the first one that Zach called
SHLL.
SHLL, exactly. The charts are identical. We talked about it 2 weeks ago that SPAC needs to get through the muck, then it would have a breakout. But it needs a catalyst. Obviously it's merging. And the Magna news was fantastic news, but because everyone expected them to announce the that the deal was finalized and all that. So because it wasn't that,
And the eye fisker with Apple.
the Apple rumors, man.
I mean, the thing is, like, I think it all just goes back to people putting too much in it. And even I have 10% in it, and maybe like 10 to 14% depending on the day. I do flip a little bit, but it's one of those things where even I, as it moves, I'm like, damn it, dude. If it moved down like 50 cents in a day, I'm like, shit, that hurt. And I think I put too much into it at 12%. So I think if it's one of those things where it totally affects your whole day.
Yeah.
It's one of those things where, and I know a lot of traders are, okay, I'm going to put all in this, but they can, and they're not worried about it. And I think that just goes back to a mentality thing. So
exactly.
I think, just see what comes, play it more careful. If you need to trim.
Yeah, trim some. I think BSS says it great. If you're worried about it, sell some. And then I think the other thing, and we talk about this a lot, your strategy should be the biggest upside, okay, in the least amount of time. Biggest upside, least amount of time. So, just for the future, if Zach calls something and he says this is 3.5 months out, maybe if you want to get in here, add 2% of your portfolio so you have a little bit of skin in the game, but and you have that average, but then it's not screwing up your life if the market halts down and this thing goes down 10%, So
yep, it's just one of those things. Everyone learns something from it, and that's just the way it goes. So another question about Hertz and Kodak. They kind of wanted a difference in the theories about what kind of happened with them, and I kind of got some insight from two guys in Atlas, Nolan and Mr. Bearfucker, and their combined little input on this was that Hertz is a value investment play as they have equity in the form of inventory, especially based on the void in the used car market right now, while Kodak a month ago reported a 13DA showing a major stakeholder sold a good part of the position. The bad part about that was a few furus, namely I think it was like Will Mead, said that instead of selling the position, they said the stakeholder added to a position. So when no one reads and people post, instead of selling off, Kodak went up 20% after hours. So I don't know, there's two of those things. I think both those guys have a lot of good answers for you, and Atlas Scalp team that may help you out there as well if you have anything on that.
Well, first, side note, can the SEC get Will Mead for market manipulation? Like, that's market manipulation, if I ever saw it.
I don't know. I don't know if that was specifically him. I don't want to slander anyone's name. Yeah, I'm not sure. I mean, maybe if he just adds the handy dandy, not a financial advisor in the bio, apparently you're just immune. Right?
Yeah, I guess. Wow. Yeah, I mean, I'm just thinking about it.
Well, he's an algorithm according to Bob. He's not like real. So, I mean, who are you going to arrest? A computer?
Oh my God.
You're going to arrest like just a coding format?
Yeah. So first off, side note, Bear is such a smart dude. We try and get him go on the trading floor more because he's so smart. His Sharpe ratio is probably like 5, honestly. So that's a really good insight. I mean, that was a perfect storm for Hertz. Also, commonality is also a huge thing. Like, I know one of my neighbors who doesn't trade. He's a firefighter. Great guy. He traded Hertz 3 times just because he heard of Hertz before. So he was like, yeah, sure. Like, sounds good to me. So it was kind of like the perfect storm. It definitely played into it. With a lot of these BK runs, they do, or, like a lot of these runs is that they get, super, super, super undervalued because of the amount that they hold in, as Bear was saying, liquidation. In equity, or when they go to liquidate, it's worth more. So that's where a lot of these runs come from. But Hertz had the perfect storm. Will Mead. Say what you want. He's a pretty smart algorithm or person, whatever you want to call him. I don't even.
Sometimes the algorithms are.
Yeah, exactly. Yes, I mean he does know. I mean he's sometimes when he does those option calls and he's like, Disney 126 for October 15th are flying right now. And then all of a sudden, 20 minutes later, he's like, see, I was right. And they're up 40%, but that's simply because of his tweet. So, I mean, sometimes that's a little bullshit. But overall, he does have some really good analytics, or he or it, whatever. Him to get it wrong and to say something like that on Hertz that was already had the perfect storm brewing. I mean, it really was the perfect storm.
No, that was Kodak with the 20%.
I mean, both really had the perfect storm.
Oh, okay.
You wouldn't see either of those. Like in a normal, I would say in a normal year, maybe you have one of those. But for two in that short time span, that short of a time span apart from each other, perfect storms.
Okay, well, I guess that kind of sums up this week in the market. And to go into technicals, most of it is, like we said, in that Traders for a Cause video. It'll be linked in all the descriptions we have. They do a stream. I think they're actually doing one this afternoon as well. But yeah, kind of to start off, like I said, they had a pretty lengthy seminar on all technicals, and we decided we'd refer you to that. So make sure to check some out, and we're going to go over some questions here and some other charting methods that we like. Yeah,
quick plug for them. They do a great thing. A lot of the guys that they have on Traders for a Cause do paid programs, and twice a year they put together this seminar. And this seminar is free minus what you donate. And so a lot of these guys, what they do is that they take a little piece of their paid program and they put them all together inside the seminar. They don't make any money from it. It all goes right to charity on childhood cancer, I think, right now. They did COVID for the last seminar. It's really awesome. A lot of them, not only do they do a little bit of their program, but then they donate on top of that. So, I mean, listen, a lot of their programs are a few $1,000s, and you guys are getting it. I think it was 8 hours yesterday. I think it's 8 hours today. Research, mentality, like we talked about, technicals, outlooks on the market, what to look for. I mean, it's basically like you're bringing a little bit of every piece of trading into this seminar.
Yeah, and these are like 8 hours long with 10 people a pop, and it's free. So if you want to pop in there, toss them $15, $20, I'm sure it'd help them out a lot, and it's for a good cause. And I'm pretty sure you can write it off.
They're literally just doing it out of the kindness of their heart for cancer.
And this is actually not a promo for them. Hugh actually just knows all this shit.
Yeah, no, I was literally, that's our plug for them. They're doing great work.
Right. But like we said, they do all these seminars that we're talking about right now, they are for free. So to start things off, there are obviously tons of indicators and charting methods, but you personally, what is your favorite chart to kind of add into for swings and even some day trades?
So for day trades, my favorite kind of chart is relative volume is at least 2 times what it is per relativity. So if we're looking at it and say it usually trades around 10,000 shares per hour, this is just a number, This is just a number. 10,000 shares per hour. I would like to see it trading around 20,000 shares per hour. This is obviously a news play. And I would like to see it spike up in pre-market, come back down, maybe hit VWAP. That would be my first starter. Obviously, volume has to stay stable. And then I would like to see it go up a little bit, maybe reject, come back down to VWAP. That's when you load your second spot. Of course, volume is staying the same. And then, that's a double bottom. And then when it starts to curl back up, your last add is when it breaks that retest on that, not the high of the day, but that second retest from the VWAP bounce. On that break should be where volume soars. And then obviously if it breaks new high of the day, then it just runs off to the races. But if it doesn't break that high of the day, then, you would like to see it come back down, create support higher, of course, higher lows, higher lows, higher lows. That's my favorite day trading pattern. That's really the only one that I'll consider taking for a day trade. That's really my only kind of strategy that I love, that I would feel comfortable, going heavy in. Everything else, maybe it's just like a speculative.
Use the same one for options?
Options are a little different because they're on large caps, and basically what I do for those, I'm not looking for a news play. What I'm looking for is, again, still high volume, so at least normal volume on the large caps, and what I'm looking for, I'm identifying my support and break, and usually what I'll do is that on my support and resistance, I would like to see usually an ascending wedge because I'm mostly long on those. I don't usually do too many puts, but I'll look for an ascending wedge, and I'll take a little bit on the ascending wedge as it gets tighter, and then as I see the volume coming, and kind of it depends on the day, maybe like, because a lot of people consider the low of the day in large caps around the 230. So what I like to do is like around the 3 o'clock when the ascending wedge is getting tighter, and I feel like that low of the day was that 230 bounce. I'll take some there, and then when I see it getting really tight and I feel like it's going to break out soon, that's when I'll take my last ad, and then into exhaustions when I sell. That's basically my large cap options strategy. I don't like my risk to reward as much as my swings, obviously, because I feel like my risk to reward on the options is a little bit less. But nevertheless, it pays the bills. It's the only strategy that I'll use, and that's my strategy.
Yeah, so when the swings you're looking for that are these bottomed out plays that you believe are fundamentally undervalued, how do you know exactly when, or how do you identify when you think they're bottomed out?
So I mean, usually what you would like to see is that you would like to see, if I'm looking at because I love the 180-day chart, 180-day 4-hour, I would like to see it on the 180-day 4-hour chart. I would like to see it create its lowest. I don't need to catch something. If it was at $4, I don't need to catch something at 20 cents at the very low bottom. Okay, if it comes back and it's at 35 cents, that's what I would much rather see than try and catch the bottom. If you guys have ever noticed, has anyone that you know or follow or that you've talked to, whoever tries and catches the bottom is usually never right. Very rarely are they right. I know a few fund managers who tried to catch the bottom in 2008. Guess what they would do? Try and catch the bottom. It would go lower. They would panic sell. Then they would think that was the bottom. Again, buy, panic sell, all the way down. I can literally show you where they bought and sold. So don't try and catch the bottom. I never try to because I think that's dumb. So what I do is I let it come down, I keep it on my radar on the 180-day chart. Maybe like 2-3 months ago, I would like to see it at its bottom 2 months ago and start to curl up. Or not necessarily curl, but sideways action to a curl. That's my favorite bottom. That's how I and then I create my own support and resistance lines.
Almost cup and handle, sort of?
Kind of, but so if you look at it, something that, this is super over-exaggerated, but let's say that we're looking at the 180-day chart, 4 hours, and you have something that's $2 and it plummets to 50 cents, and then for the next 2 months, it just trickles down to like the 30-cent mark. So say that was like January. Then I would like to see it trickle down to maybe like the 30-cent mark by April. Then maybe May and June, it starts to do some sideways action, and it slowly goes from like 30 cents to 40 cents, okay? And then like July, we start to see a little more action, so now it's at like that 45-cent mark. That's when I would consider the bottomed out. That's when I consider bottomed out, starting to cup and handle. Although it has a long way to go, that's what I consider like a small cup and handle.
Yeah, I think even like to really hint on what you're saying, if you look at the chart of PAC-D, I mean, you see in like last October, it's around 250, peaks in January during the Iran shit, all the way at $6.30, and it's just slowly trickled down all the way to 25 cents. I mean, you may have thought it was done at 70 cents back in May, just kept going down. I mean, I think that's what you're really trying to avoid in these situations.
Yeah, exactly. Exactly. That's what you're trying. Yeah, don't try and catch bottom. Just don't try and catch bottom. You just wait for confirmation. I think the guy who, when I was really younger, who I used to follow a lot, was Ricky Gutierrez is his name. And he didn't teach me, but one of the things that he always harped on was waiting for confirmation, and that confirmation is key. And I had to learn that the hard way by trying to catch bottom. But that's true. Okay, fine. You miss out on 10%. It is what it is. But on that but say that you're missing out on that 10%, the risk that it'll go lower when you try and catch bottom is so much greater than giving up that 10% and waiting for confirmation.
Yeah, if your reward is only 10% versus the risk of it going to continue dropping a shit ton more, I would definitely watch out a bit.
Exactly.
Yeah, so I feel like this kind of touches on basically what this is, but I feel like in this market especially, it's a good idea to know when to add a dip and when not to, and not only for like waiting for confirmation, but I guess you could wait for the confirmation. You know the meme, I added the dip and it just keeps dipping. I feel like a lot of people would love to know how to avoid that, and I feel like charting is one of the best ways to do so. Would you kind of basically say that's the same thing as looking for it to bottom out, or maybe just looking for the proper support?
Yeah, so if you're doing a swing, you should already have your levels charted out and a plan. I can't harp on this enough that most of the time I'm expecting my swing to go down. And I would like it to go down so I can add on dips. You should be wanting dips. If you don't want dips, then you're not confident enough on your swing. So most of the time I'll say, okay.
Or your position is just too high.
Yeah, or that. Yeah, or your balls
much.
deep at way too high. So most of the time when I'm looking at something, I'm saying, okay, if it's at 65 cents, I'm going to say, okay, my support is around that 55-cent mark. I'm going to add 30% of my more position. If it starts to curl back up, I'll add another 5%. If it breaks through that, then I'll add another 30% at 50 cents because that looks like my support. Okay, and I'm not just throwing these numbers out there. Okay, you got to look at the chart and you got to look for that support and resistance. Now, it doesn't always mean that it's going to hold that support. That's why you don't, again, go balls deep on that support. But always have a plan, and this is what I we harp on, is that if you have a support, find your support and resistance and have a plan. Okay, add a 20% of your position as a starter. When it comes down to that support, add another 30%. When it breaks through that support, add another 30%. When it breaks through that support, now you add your last 30%. Now you have your full position. If not, you don't always need, if you want $1,000 inside a stock, you don't always need $1,000 inside that stock. Start with putting in $200. On support, add $300. If it breaks through that support, add another $300. It's all about risk management.
Yeah, I think, so basically I think what you're saying is have a better starter position. When you add it, don't go balls deep, be careful. And then on those dips, know where they are, like you said, trade a plan. And so I guess whenever you are, let's say you don't get exactly how much you want, is there ever a time that, adding on a break? I know you always like to add on breaks, but you got the money to break the walls and kind of add to some of that volume and everything going towards it. But what for the little guys, when do you think they should add on break? If they wanted $1,000 in the stock and they only got to 400, would you say settle with that? Or if you see a key break at 30 cents or something, would you add more?
I'm going to use AdMP for this example. So we got in at a fairly low price, and it
like 84 to 88.
Yeah,
right?
like 84 to 88. And so in that time, if you wanted to add 50, like I added 50% of my position at 101. In hindsight, was that the smartest thing? No, because I didn't know there was going to be a certain person tweeting about it at 4:30 in the morning, completely just putting it into oblivion while I was sleeping. And then, obviously all the retail sellers just bought it right back down. I was expecting it to go organically. But that being said, because I had such a low average at that 84, 85, even though I added another 50% at 101, now my average is like 91 cents or like 91.5 cents, which, okay, yeah, it's significantly higher, and I definitely screwed up on my position. On my positioning, I definitely screwed up, but I didn't screw up to the point to where my average is absolute horseshit. Because I had that great average, and now my average is meh, okay, 91, 92 cents, okay, it's fine. But if you want to add, the biggest thing is going to be not how much you want to add, it's going to be what does it do to your average. Okay, when I'm thinking about things, it's less about, okay, I want this amount of money in, how much do I have to do? To me, what I always look to do for is, what is this going to do for my average? Would I buy this stock, okay, at 101, or would I buy this at 92 cents? Okay, when I saw that I would buy it that my average would go up to 92 cents, I said, hell yeah, done, I'll buy it at 92 cents. That's my average, fine. Now, if it brought my average up to $1, would I be buying there? I certainly wouldn't have a full position at $1. I would buy a starter there, fine. But then that's when you say, okay, if you're gonna buy at 101, fine. But you make sure that you have money to average down. I did not have money to average down. So therefore, I said, okay, I'm only going to do half a position here. Really, the biggest thing that I would think of is I would add a starter and then I would see what it would do to your average. Because not only are you adding at 101, you got to think about your risk. Okay, yeah, you're adding at 101, but now you have 20% of your portfolio into it. So if it dips, can you really add that much more? So it's screwing up your average and it has a chance to dip and you putting in more than you really want to have in there. So I think that that's a really big thing that no one really thinks about is what is it going to do to your average?
Yeah, me, whenever I'm I'm more of a scale out instead of an add-on break. What I usually do, I'll be what part of what they're trying to break or a little below, and if it doesn't break that, that's when I'll add again if the volume's still there during the day. So I usually don't add on the breaks, but yeah, I totally understand where that risk reward comes in and how it can be so valuable. Because I mean, if it would have kept going like we all expected it to, I mean, it would have been like another huge win, another 20%.
Yeah.
So I kind of feel like that kind of goes into the next thing of, have you ever felt like a chart betrayed you? Like everything was perfect and it just went tits up and not on some like news or bad tweets?
Oh yeah, of course. I mean, I always assume for downside risk, but sometimes things just don't work. I mean, I could have...
Yeah, I mean, everything can be perfect, and it just doesn't work. Isn't that the beauty of the stock market?
Yeah, exactly. I mean, that's why we get paid so much sometimes. Because, I mean, more people lose than win. But the people that win...
Yeah, there are no guarantees.
Yeah, there are no guarantees. Like, if there was, wouldn't you just throw your entire net worth into it? But no, there's always going to be uncertainty. No matter how good the setup is, there's always going to be uncertainty. And there's always going to be, a potential downside, or hell, it might just not work. I mean...
Yeah, I mean, and then you have to toss into the fact of just human error. I mean, these companies are run by people as well. So, I mean, even if there are charts, you have to think there's so many errors.
Yeah, there's so many errors. And then you got to think about the outliers. You have the market. You have the industry, things like that. I mean, when the market slows up in August, I mean, sometimes you could have an FDA drug that is just a slam dunk, and it can move 10% and then tank on the FDA approval because there's just no volume. So sometimes it just doesn't work. One of those times for me was... Let me see. I'm trying to think of the most recent one. But, Rumble. The second time that we played it, the first time that we played it, it went 100%. The first time that we played it. That was a really nice payday. That was perfect. Then the second time that we played it, it took 4 months. I was adding 40% lower than where I originally bought. And people got really pissed at me because they were like, Hugh, this is never going to work. This is never running. And then it went to 40, bitches. But at that time, I thought that everything was set. I thought the chart was perfect. It was a recent reverse split. I thought that everything was perfect. I thought that based on seasonality that the insurance check would be here super soon. And then everything took 3 months. So that's a perfect example of, okay, everything was perfect. It just took way longer than I expected. So could you imagine if I sold? Timing is also a huge thing inside the market. If I sold and then I saw that, I would have been so pissed. So that's just a perfect example where I had the DD. I thought I knew when the insurance check was coming. I thought the chart was set up, and it wasn't. It took longer than expected.
Yeah, even for some more just technical based example for me, it's just some of the things that I saw like an SXTC. I mean, so many people were expecting a good double at around 50 cents to we just wake up and be $1 one day. And I like that potential as well. And now you look back at it as 25 cents. And I like that support as well. So, I mean, a lot of these things I kind of attributed to just August downfall. But as I looked into it more, I realized, there's some things, there's so much you could learn from whenever you find those dips that just keep dipping or a chart that betrays you. Because, you can always learn from that kind of shit, too.
Yeah.
All right, so that kind of sums that up. And we do have a couple more questions. So just for 2 more, what is okay, so strategy through election and the certain uncertainty after when we don't know who the winner is. I think he kind of means due to the mail-in ballots, we won't know who won for about a week. What do you kind of think about that?
Yeah, so I totally understand where he's coming from, and you guys will hear this. I will never try and guess the market. I totally have. I'll always have a ballpark, but I'll never put my money where my mouth is. On like I personally think that we'll go into a recession. In like 2023. I think that's when the other shoe will drop. But I'll tell you right now, I'm not taking puts, or I'm not doing any of that to put my money where my mouth is just yet, or in general. So I just want to put that disclaimer right there. So as far as that goes, my personal thesis is that because of how many people early voted and how many people are still going to do it in person, that we should still know the election results on normal schedule. I don't think that we'll have to wait a week. And if we have to wait a week, I think it'll kind of be more of like a confirmation and less of like a, I think the chances that it comes down that's 50-50, 50% and 50% between early voting and online or, in person, I don't think that it'll be so close to where waiting a week for the mail-in ballots will make a difference. And even still, I don't know if the market would do too much. I mean, of course, volatility is going to happen, and of course, we're going to see some choppiness like we're seeing right now. But I don't know if we'll see extra choppiness, if you will. I think it'll be kind of what we're seeing now. That's kind of my thoughts on that because
So you're not expecting a Dewey defeats Truman kind of newspaper thing.
Yeah, no, I'm not saying
so you're
like
kind of expecting us to know based on what do you kind of expect just on who all voted already or what? Because I mean, even when you think about the last one, I mean, we all thought up till the day before, most polls thought Hillary was going to win.
Yeah, no, exactly. I don't think it'll be like, okay, I will say this. I do think that although they're giving, I think it's like they're giving Biden. All right, by the way, guys, I just donated more money to Traders for a Cause because I'm in a good mood. Yeah, sorry, that's what I was doing. I don't think it's as far of a gap as they're claiming. I think they're claiming like an 11-point gap right now between Biden and Trump. I do think it's much closer than that. And even though Trump was a huge underdog in 2016, I think that this is kind of the same situation where people are definitely underestimating him, I think. Or not underestimating him necessarily, but I think it's a much closer battle than the polls are saying right now, than the 11-point. I don't think it's
contradicting yourself now, huh?
Yeah, a little bit. I don't think
Yes.
I definitely think
you don't think we'll have to wait a whole week though.
I don't think we'll have to wait a full week. I think there's two ways that this goes. Either it's such a big personally, this is what I think. I think right now it's a much closer race than they're saying. I don't think it's an 11-point gap, but I do think that Biden has a pretty good lead on Trump right now. And I think that it goes one of two ways when it comes down to the votes. I think either there will be so many early votes and so many in-person votes that it won't matter what the mail-in ballots do. The mail-in ballots will just be confirming the winner. Or I think that there will be such a gap inside whoever wins that the mail-in ballots won't even matter. Like it'll just be like, man, whatever. Like every single vote would have to be to the other candidate for it to happen. Yeah. So that's what I think.
All right, so next, you did tweet out today, saying the short is crucial when finding an entry. There was a little confusion on that. Could you kind of touch on what you mean by that?
Yeah, so I think that tweet got really confused. I try and tweet out on the weekend when I'm doing, when I'm going over my trades and I'm going over stuff, things that like really come to mind, I try and tweet out. And so that's kind of where this came from. I was sitting there in the morning, and I think it's really important to think of both sides because even though I don't really short, I rarely short. I always like to think about if I was a short seller, would I be shorting the stock here? And that gives me a really good insight into, okay, if I wouldn't short here, then this is maybe a pretty good entry for me. On the opposite side, when a stock's running crazy, when a stock's up 200, 300%, and I'm thinking to myself about, taking a day trade on it, if I can think here and say, okay, would I take a short here? Or if I was a short seller, would I short here? And if I can answer yes to that, then that usually stops me from taking an entry. Because again, even though it can and probably will go higher, I'm looking for the best risk to reward, and it's all about preserving my capital. So I'm not necessarily talking, when I said that, I wasn't necessarily talking about the short percentage of a float. Specific to that tweet, I was talking more about when I'm taking an entry on a day trade.
All right, and very last one before we get on the road. Lost stories and how you learn from it. I'll start off. ONTX for me. I mean, I made a good bit right as it started. I scaled out, and then as it dipped, I added more on that around 90 cents and $1. And I thought it was a good position, but I think I should have learned more about. I saw the big sell-off. I didn't think much about it. I thought it was just a dip that got gobbled up and ended up dropping to around like 22 cents. I ended up selling for about 26. So that was a ginormous loss for me. And it definitely is going to change the way how much I put into phase 3 data plays and how long I hold. I wasn't expecting that phase 3 data, and it's just something that I had to learn from.
Yeah, I think, so a lot of you guys know that I love playing bios. I think that really taught, that play especially really taught how crucial it is to watch your position sizes, because even though it tanked, I know a few people that had that well diversify their portfolios, and it didn't hit them really that difficult because of their position sizes. Whereas, if you were, I know someone else, he had a majority of his portfolio inside that biopharma. And so he really took a pretty big loss, obviously. So that was a pretty big loss relative to his account percentage.
You talking about my Webull account?
Yeah, that one too.
Yeah, that one turned my Webull account from a swing account to a Levi shares and paying the rent account.
Let me see. And then, one that was for me, you know what? AMRH 3 years ago. This is when I was new and I would drink the Kool-Aid of everybody before China Hustle. Oh man, dude.
Because you couldn't drink beer yet, right?
Yeah, that's true. I couldn't. I drank the Kool-Aid of AMRH 3-4 years ago when they were starting to do their Google accounts and all that nonsense. I lost a good bit on that. I think I lost like 50 grand on that 3 years ago.
And not to mention, there's your weekly China Hustle advertisement.
Yep, China Hustle.
Live Sports. Go check it out.
China Hustle sponsor me. China Hustle.
I just noticed that you wanted to be sponsored by a documentary movie about pumping stocks beyond their value and lying about the value of stocks.
Yeah, sponsor me, China Hustle.
I'm the opposite. I'll do better.
Yeah, please sponsor me. Thank you. Q Henny.
What else? So what happened with AMRH? They just sucked?
Yeah, AMRH, they were spitting this huge tale about, they were making, at this time, I really didn't do DD. I was just like, AMRH says that they're going to be bought by Google. Okay, cool. I was like, this trading crap is easy.
The Motley Fool's got this shit figured out.
Yeah, exactly. So let me see. So they started their Google advertising and their Google partner course, which at the time I thought it was like a partnership, like Google wanted to partner with them. In reality, they were paying Google to take courses, kind of like someone would take Investors Live course. It's not, Investors Live doesn't want to partner with you. I mean, they do want to partner with you, but they were making it seem like Google wanted to partner with them, when in reality they were paying Google to take an online advertising cloud software quiz and crap. So they were spinning this big tale, and I was too stupid of a retail investor to really look into it, and they just kept going on and on, and they would have delays, and they would do this and that, and then all of a sudden they had a reverse split, and then they went from cloud software to weed. It was just such a mess. I just kept writing it down.
Now they're doing they're doing blockchain.
Yeah,
right?
Now they're doing blockchain.
Like
I mean, they just. I mean, honestly, and this was I used to. I still have my trading journal. I used to write down don't worry, it'll be worth it. Conviction.
The next 3 days were just like fuck.
Yeah,
fuck.
literally, it was like have conviction. You know what you own, and I didn't even know anything about it. I just heard Google.
All right, well, I guess now we're smarter. You know, you've seen the China hustle, and next week we're going to talk about PR, buzzwords, and how to read a PR just by the logo and some tiers of them.
Sponsor me, China Hustle.
You heard? Word. See y'all next week.